Hello, welcome to chapter 10. We're going to work on the problem assignment together. So let me share my screen. All right, so to access our homework, in case you haven't kind of figured it out or you need a little assistance, you can either scroll down to chapter 10, find where it says homework, click it. I can't do that because of my being the professor. It makes me go through this side. This is another way you can access anything in Pearson. Click Access Pearson, click Open Pearson, click Open My Lab and Mapping, give a retina scan and a blood sample, and hopefully you'll get in. Just kidding about the retina scan and the blood sample. So I'm going to come down to assignments and then click do homework. Now, this is an assignment that, according to this assignment, is past due. Don't worry about that. I'm just showing you how to do this, and I'm going to do the work. So you should hopefully be doing this. So it's not past due. Don't do it past due. Past due is not good. All right, let's start off here. We're going to start off with getting me closer to my mic. There we go. Maplewood Properties bought 3 lots in a subdivision for a lump sum price, and we have some appraisals. Here we go. Throughout the process here, I may be using a lot of Excel. So I am going to actually open this up because this really doesn't show the breakdown and how that looks, and I'd rather you see that as well. So boom, there is Excel. We have 3 lots, so I'm going to type in here lot 1, lot 2, and lot 3. The appraised value for lot 1 was 127,500. Lot 2 was 204, and lot 3 was 178,500. What we need to do, and I'm going to just make these into some dollars, is we need to allocate this cost. We paid $320,000 for it. So we're going to allocate this cost to each one of these lots. And the way we do that is we come up with a percentage. So I'm going to add up these 3 of the appraised value. Why is that merged? Merged. So I'm just to use this for something else. Okay, so I've set this up. This one's lot 1, the appraised value. This is our total appraised value. So what we want to do is we want to take whatever the amount was for lot 1 and divide that by the appraised value here. And for reasons that you don't need to worry about, I'm locking that cell in. What? It wants to be a percentage, not a date. I must use this sheet for something else, and I didn't unformat it or whatever. Okay, so there we go. So the lot 1 was 25% of the total cost or the total appraised value. Lot 2 is 40%, and lot 3 was 35%. Now what we're going to do is we're going to take these percentages and we're going to allocate the purchase price to each lot. So lot 1 needs 25% of the purchase price, which, as we see that, let's go ahead and format these so that they look cleaner. Lot 1 needs to be 25% of the purchase price. So 25% of the purchase price is going to be 80,000. And then we got to make sure that all of these equal 320, it does. So we're going to allocate of this purchase price because it was 25% of the appraised value. We're going to allocate 25% of the cost to lot one, which is 80,000, 128,000 to lot two, and 112,000 to lot three. And that's going to be our journal entry here. We're going to debit to lot one, lot two. Oops, it didn't take. And then lot three. And then we're going to credit. I'm assuming cash. It didn't say anything else. So we're going to now pull this information. So we're going 80, 128, 112. 80, 128, 112. And the full purchase price was 320,000. And it's to allocate, to record purchase of lots with cash. Okay. There we go. That's how you allocate these costs. All right. Let me take a drink while I read the beginning part here. Mama's Fried Chicken bought equipment on January 2nd, 2025. What are we doing here? Okay, we're doing depreciation. So our asset cost was 21,000. So our book value at the beginning of the year is 21,000. Now I should have demonstrated this to you already in a lecture or other problems that you should have seen. The bottom line is depreciable cost for the year is going to be the 21,000. It's always going to be the full. Oh wait, I'm sorry. Depreciable cost. The equipment was expected to remain in operation for 3,000. Okay, we need to know what residual value, salvage value. Okay, please understand that I use those words interchangeably. So we took our asset cost and we subtracted out the residual or salvage value. Useful life. Actually, this is a straight line depreciation method. So we're looking for the number of years, 4 years. And what we want to do, since this is the straight line method, is we're going to take that 18,000 and divide it by 4. So $4,500 every year is going to be our depreciable costs. And it's going to be every single year. It's why it's the straight line method. Doesn't change. So I'm just filling these in. All right, accumulated depreciation for the first year is the depreciation expense for the first year, and our book value will be this 21,000 minus the accumulated depreciation. So our book value in year one is 16,500. Accumulated depreciation is 9,000. We're just adding our prior accumulated depreciation plus our current year depreciation to get that 12,000, 15,500. I am recording this in the morning, so my brain doesn't always want to work in the morning. So if I've done something wrong already and you're like, Brian, you suck at this, just love me anyway. Okay, there it is. Notice our accumulated depreciation equals our depreciable cost for the year in the last year. Our book value at the end of the year is the same as our residual value. If something is different, you've done something wrong, okay? Now, depreciation expense per unit. We're doing this the units of production method. So we estimate 3,000 hours. So we're going to take our 18,000, divide it by the number of hours, and I've already forgot what the number I said. 3,000. So we should have it $6 per hour. So then everything up here is going to be identical as far as the start. Now, depreciation per unit for the year is going to be 6, and that's going to be 6 for every year. And then it said up here, it gives us the information for the units. The equipment operated for 300 hours, then 900, then 1200, 600. Now we're going to have to watch that 4th year because we can't over depreciate this. And that could happen. So we have to be careful. So we're going to take that 6 times 300. So in year 1, we're going to have an 1800 depreciation and accumulated depreciation. Same math, just different numbers to get us that information there. 6 times 9,000. 6 times 900. 5,400. I should be able to do this in my head. 72,000. 7,200. 13,800. I'm just doing the math. Whoa, divided by 7,200. So we doubled it. Look at that. 9, 10, and 12. It makes sense. All right. So with our residual value is 3,000, the most we can depreciate in the last year here is 3,600. So let's look and see 3,600. Oh my gosh, we nailed it. Somebody needs a raise. That's not going to happen, guys, in real life. That just isn't. Just no way. Good on whoever guessed that. All right. This last method is one I absolutely love. It's my favorite in all the world. If you can't sense my sarcasm gripping, um, well, it is. I just whoever does the double declining balance method or the accelerated method of depreciation hates their accountants. Okay, nobody uses this hardly. I think like 95% of companies use the straight line method. Then you have others who will use the units of production. I mean, basically 5% of companies use something other than FIFO. So you can see how often you're going to see this double declining balance method. All right, let's start off here. 21,000. See, the difference is though, is we're taking, instead of calculating the depreciable cost or depreciation per unit, now we're still just using the book value. Okay, that's where the difference is. Now, the double declining balance rate for the year is going to be the 4 years times 2, because we're doubling the number of years basically to calculate this. So, actually, it's this one. Sorry. It's 2 times 1 divided by 4 because it's 25% is the 1 divided by 4. And then we're doubling that. It should be 50%. So I had to think that one through. That's why I hate this method. So bottom line is we're basically taking 50% of this every year. But I'll show you this. Watch. 1 divided by 4 is your 25. Then multiply it by 2. That's 0.5, right? That's 50% or half of our book value every year. So half of our book value, all we got to do is just take 2,100 divided by 2. So depreciation expense in year 1 is 10,200. Accumulated depreciation is the same. And now our book value is 10,200 because we just basically took it all and put it in half. So our double declining balance method stays the same. But now we have 10,200. We're going to divide that by 2. 5,250. 5,250. Add that to 10,200 and we get 15,450. Pretty sure. I hope I did that math right. . So all we have left is this 5550. Now, if we took this and divided it by 2, it gives us 2,775. I'm going to show you this. Don't do this with me on your homework. Just watch now. We did this 2,775 and then added that to accumulated depreciation. It gives us 18,225. And what that's going to do is that is going to depreciate this asset lower than its $3,000 residual value. We can't do that. All right. We've got to stop at 3,000. So we're only going to be able, we're not even going to, that's why they don't do this calculation right here, is we're going to do 2,550, and that should get us to 1,800. Let me just punch that number really quick to make sure. 5550 minus 3,000. Okay. So then year depreciation expense in year, enter 0 for any items with 0 value. Okay, so we're going to do a 0 here because in year 4, we've already depreciated it fully. We don't need to depreciate it further. Uh-oh. What have I done wrong? Well, I got this one right. All right. I was trying to do stuff in my head. Oh, I think, okay, 21, 10,000. Why did I put 200? I have no idea why I put 200. I must have just mistyped. Because see, then I got this one right. Plus 15,750. So you should just always use your calculator. 52. So then this one should be 2. All right, that one should be good now. All right, which method tracks the wear and tear on the equipment most closely? That's going to be your units of production, all right? Because the more you use an asset, the more likely it's going to actually wear and tear. All right, good. Next question. Depending on some of these, though, I might skip them just because we're not gonna. I'm not gonna keep doing the same thing for you over and over again. You should be able to learn how to do it, know how to do it. I mean, all right. We purchased showroom fixtures for $17,000 cash, expecting the fixture to remain in service for 5 years. Has depreciated the fixtures on double declining balance basis with 0 residual value. We sold the fixtures in 2025. So a year and a half later, record both depreciation expense for 2025 and sale of the fixtures. All right. So it looks like we're going to have to do a partial year depreciation since it's January and August. Boy, I really picked a doozy for us, didn't I? Okay, begin by recording the depreciation expense for January 1st to August 31st. All right, well, we're using the double declining balance method. So I'm going to break out my daggum Excel because I don't want to have to mess this one up. So for some stupid reason, we decided to do the double declining balance method, which means what's our number of years? 5 years. So that's 1 divided by 5 is going to be 0.2. And so we're going to double that. Okay. So it's 0.4. So in year 1, we had 60. So this is our depreciation expense. And this is our accumulated depreciation, which in this case is just the same thing. So our book value is going to be, and we had no residual value, not that that matters. Okay. So we're going to do that, get that rate again. So in this situation, our annual depreciation expense should have been 4,800, but we're only doing it for January, February, March, April, May, June, July, August, 8 months. So what we need to do is I'm going to take 8 divided by 12, multiply that. So I'll open this up just so you can see it, the formula here. I'm taking the book value at the beginning of the year, multiplying it by the rate. That's an annual depreciation rate. Multiplying it by 8 divided by 12, which represents the 8 months out of the 12 months that we owned it for. So our depreciation expense should be 2720. I'll move this up here and debit depreciation expense, credit accumulated depreciation for the 2720. And then we're going to record depreciation on fixtures. Yay. Okay, the fair value of the asset received. What did we get for this? We got it for 8,200. The cost of our asset that we're selling is 17,000. The accumulated depreciation is okay, so I just finished the chart here. We need this information. Our accumulated depreciation is 9520. Cost or beginning book value. So our accumulated depreciation is 9,520. So our book value is the 7,480. That represents the amount of money that we have not yet, the book value that we have not yet expensed. So anything we get above our book value will be a gain. Anything below it will be a loss. So we're going to take 8,200 minus 7,480 and we have a $720 gain on this sale. Now record the sale of the fixtures. All right. We're going to do everything that we know. When we're getting rid of fixtures or any kind of asset, we got to get rid of it off our books. We have 2 accounts that we have to deal with. First one is the accumulated depreciation for the fixtures. We calculate that at 9,520. That's a credit balance. We got to get rid of it. So we're going to debit that to get it off our books. Then we know we're receiving cash. We're debiting cash the 8,200. Then I'm going to skip a line. I always skip a line, even though they had us already calculate that it's a gain. I skip a line, and then we're going to get rid of the fixtures themselves, which cost us 17,000. And then if we didn't do this exercise above it, we could just add these together, the debits, subtract those out of the credits. And if you have a debit balance, you need to balance it. It's a loss, and a credit balance would be a gain. So we're going to click gain on, should be gain on sale, but it says disposal, whatever. Sold fixtures for cash. I like that question. That was good. It was hard because of the partial year depreciation thing, but I think that was a good one. Minerals. Okay, so we're doing basically the units of production method on this. Begin by journalizing the purchase of the minerals. It says to debit the minerals asset. All right. Paid 1 million. All this rights to extract from A to K. Also paid a 1,200 filing fee, license fee in the state of Colorado. It's probably not high enough for them. Geological survey. All those costs are going to be put into the cost of the mine. So we're debiting minerals for the total amount of all this. So we got 1,601,700 plus 1,200 plus 2,100 was 75,000. Wish they'd give you ones that are not like just everything, because it would make it easier. 1680. And then how are we paying for this? Paid. Said paid. Dude, if you got 1,680,000 just lying about, come chat with me. I could borrow some of that. Did I forget something? Did I calculate that wrong? So we didn't buy the land, but I don't know why we bought for mineral rights. Check. I wonder what it's saying. I think it's 75,000 for the property. Maybe that because we don't buy the land, it's 75,000 is not part of it. I find that odd because it's still the geological survey would have needed to have been done for the minerals. Just gonna add them up again, see if I just did something wrong. No, I think I have the right number of zeros and everything. Oh, it says do not record payment of any additional costs associated with it. All right, Brian, read the question. Read the question. Whatever. All right. Journalize the payment of fees and other costs. Why the? Okay, whatever. All right, what's the rest of it? Let's just take this and subtract out the cost of the minerals. And it's 78,300. Oh. Okay, journalize the depletion for the first year. So all we got to do is find out we expect to extract 800,000 tons out of it. So we're going to do the total cost, which is the 1,700 plus the 78,300. So 1,680,000. We're going to divide that by the total number of tons. So 2.1 per ton. And in year one, we pulled out 100,000 tons. 210,000. So we're going to do depletion expense and accumulated depletion. To record depletion, you got to make sure you're careful about that depletion stuff. All right, this is the biggest part about this is knowing that although you have legal protection for 20 years, we don't only expect to have a competitive advantage for 10. So we're going to go ahead and we're going to amortize this over 10 years instead of 20. So we're recording the purchase of the patent. So we're going to do debit. What patent is it? Just patent? Okay. And then do we pay cash for it? How do we pay for it? I guess cash. I wish I had $700,000 just lying about. To record purchase of patent. Every time I say patent, I want to say patent, like the general from World War II. Record the amortization for the first full year. All right, so we're just going to take that 700,000, divide it by 10. And that should be 70,000 because it's 10 years. And that's going to be amortization expense for the patent. And credit to, oh, I forgot to do this. Credit to the patent to record amortization of the patent. So this is, so intangible assets, um, you need to reduce the patent itself. A little different than our property, plant, and equipment and stuff. After using the patent for 5 years, learns that an industry trade show that another company is designing a more efficient printer. On the basis of this new information, ZP decides, starting with year 6, to amortize the remaining costs of the patent over 2 remaining years, giving the patent a total useful life of 7 years. All right, so it's really simple if you have Excel out. Let's just do this here. Here's our patent in year 1, year 2, and we're just taking this down. I think it says total of 7 years. So each year here, we've amortized this. We amortized this for 7,000 years, all the way to year 5. So our accumulated amortization, actually, let's use patent. So we don't have accumulated amortization. So our patent was 700,000. So we're going to take this minus this, and then we're going to drag that down. That's what I love about Excel. I don't have to think much. So now we have $350,000 left to amortize. We thought it was going to be 10 years. So let's look at that. Okay. We thought it was going to be 10 years. Had it been 10 years, we would have gotten to 0, but it's not. In year 6, it changes. So in year 6, we decide that we're going to amortize this over 2 years. So now we're going to take the remaining amount and divide it by the remaining years. Okay. So our year 6 and year 7 will be the $175,000 for amortization. Okay, that's it. And now the asset turnover again. Now, if you, well, again, I shouldn't say again. If you are in my 211 class, then this is again. But if you're in my 112 class, this is the first time you're probably going to hear this. I don't expect you guys to memorize ratios. Okay. I don't expect you to memorize these formulas. I never did. And I still couldn't even tell you how to do it all memorized wise. So asset turnover ratio. This tells me we're going to divide by something. So I'm thinking average total assets is going to be important. And average turnover ratio. See, I can't even remember what that formula is. So I'm going to just look it up. I'm going to come over here and I'm going to do the asset turnover ratio formula. Okay, so it's net sales over average total assets. All right, that makes sense. Net sales over average total assets. So here are our figures. What we need to do, net sales, we got 441,000. Then it's average total assets. So we need to add, these are all assets right here. We got to add them all together. Whoa, what happened to property, plant, and equipment? I wonder if there's a problem with this, because maybe that should have an extra 0 in there. Let's see if we do it just based on what they give us and if it's wrong. We got to add them all up and then divide by 2. So I'm going to go 32 plus 62, 70, 13, 45, 17. Divided by 2. So I have 264,500. So let's take 441, 123, divide it by 264,500. And I get 1.66. Where does it tell us to round to 2 decimals? So 1.67. Now, if this is wrong, all right, it is good. All right, good. We're done. The only reason why I say if we're wrong, sometimes if I'm looking at this and I see that this is 17,000, I'm thinking it probably should have been an extra zero there. So if it said it was wrong and we did all the math right, when I look at these and I compared them across the board, I would say probably add a zero there and see if that fixes it. But obviously Pearson did it right. It was right. I do think they missed a zero there, but because they probably had something calculate based on what was here. Um, you don't go property plant equipment from 145 to 17 in a year. That's quite a jump. But anyway, that's your homework help for chapter 10. I hope this helped you. Your numbers are different throughout all this. I should have said that at the beginning, but if you need help, please reach out early and often. I'm here for you. All right, guys, have a good one. We'll see you in another video.